Hello everyone. My name is Kamal Manocha. I represent PMS AIF World, a new age investment services platform meant for serious investors looking to do long-term equity investments or wealth creation. We are backed by proprietary analysis and content. Thereby, we assist investors in making informed investment decisions. When one invests into any equity product, one makes a lot of sacrifices. One departs from one's hard-earned money for a longer period of time. One puts one's capital at risk. One exposes oneself to vagaries of equity market in terms of unpredictability of returns. But despite doing so much sacrifices, an investor seldom makes dream return. Most investors over a 10-year period in equity product in general make around 12 to 15% return, or in best case I would say they make 12 to 15% return in longer term. 10 to 15% return over a longer period of say 10 years is not a bad return. It's a decent return, especially if compared to any other debt product. But after having taken so many risks and after having done so much sacrifice, if one makes 12 to 15% return, one is seldom satisfied. And the dream return for an equity investor is always around say 10x in 10 years. We get approached by a lot of investors who ask this question, that how can one create a portfolio for making a possible return of 10x in 10 years. So 10x in 10 years, just for everybody's clarification, translates into an around 25% CAGR. So to attain 25% CAGR is definitely possible, but it requires a lot of discipline at the end of investor, as well as requires a lot of discipline and ethics at the end of an advisor. So today we have amongst us Mr. Devender Fatke, who is one of the portfolio managers with Purnartha Investment Advisors Private Limited. He has 18 years of experience and proficiency in analyzing the buy side of equity markets, and he is buy side equity research. We will do a very simple conversation with him around this topic on what are the traits of a portfolio which has a potential to generate 10x return in 10 years. Welcome, Devender. So a formal welcome to you.
Thank you, Kamal.
Yeah,
and all the investors, well, thank you.
Yeah,
Sorry.
our pleasure. So, first and foremost question to you, Devender, is that is this kind of return really possible when we are talking about 10x return in 10 years? Is this very high expectation, or this is a possible number?
So 10x in 10 years is in equity markets is absolutely possible. If you look at our own track record, we have been investing from 2009, and if you look, we have done 30x in 10 years. So 10x in 10 years is absolutely possible. If you look at various stocks, you look at a Pidilite, you look at HDFC Bank, you look at Bajaj Finance, there are multiple companies which have been able to deliver this kind of a 10x in 10 years, even in the last decade as such. So 10x in 10 years in equity market for an investor who is long term is absolutely possible, along with the discipline, as you rightly said, the ability to stick around with good businesses. So absolutely yes, 10x in 10x is really very much possible in the current scenario as well.
Understand that 10x in 10 years is possible. How to go about selecting a company which has traits to make that happen?
Yeah, so like what we discussed, 10x in 10 years, I think what we need is two factors, as you rightly said. One is 10 years, and the second important factor is what you indirectly said, compounding at 25%. So I think let's focus on the first part. So what we really need is the company which is actually living through at least 10 years historically, so that we can say with enough confidence that the business can survive. You need one, longevity. So we need really the company to survive through the last 10 years. That's an important factor. The survival of the company through last 10 years also tells us that the company's products are actually liked by the consumer, and hence it has been able to go through and survive for the last 10 years. Look at the company has various products which we use day in and out, and hence these products are actually not going out of fashion, and the company is able to adopt its strategy to make sure that we continue to use it. So these are some of the things that we are really looking for. from the second perspective, in terms of 25% growth that we really need to achieve to do this 10x, what we are really looking for is what kind of a volume growth are we having. So what we really want is that the company should be able to sell the number of units every year at an incremental rate. So for example, look at a guy like Maruti. So if you are selling like 100 cars yesterday, you want him to sell 110 cars in a subsequent year. So we are looking at a volume growth in terms of number of units sold by the manufacturer consistently increasing over the last 8-10 years. So that's point number one. Now, if the company is able to sell the number of cars at an increasing rate, then we want the price of the product or price of a car to at least remain and not just give discounts and then get the volume. So from a classic example out there is like a telecom company. If you look in terms of number of minutes of usage, we have been actually using more and more number of minutes. But on the flip side, the cost per minute is actually coming down. Today we are at a place where probably things like Zoom is actually not making any revenues for Idea, but data is. So from these perspectives, I think we need to look at these 2-3 important stuff. One is obviously the volume. The second is obviously the price at which you need to pass on the volume or maintain the volume. The third important thing that we like to look for is obviously the amount of money that the company can make. So we are firm believers of fundamental analysis. So clearly we think that if the company is able to make good amount of money, then that's the only way that the stock price is going to reflect it and it's going to sustain. So we want the cash flow from operations to actually grow at a rate of 20% year on year. If you try to look at the things from a holistic perspective, what we really are looking at is that if the company is really making good amount of money in terms of 20% growth year on year, the product has been actually the company has been able to sell the product for last 8-10 years, then we really think the company doesn't need to borrow money at any point of time. So from these perspective, I think very clearly we are looking at a company which is net cash company or does not have any borrowings as of now today. Also, I think if you look at some of these classic companies like HUL, Asian Paints, Pidilite, all of them have been sustainable for long term, do not have any debt, and have some moat or uniqueness built in the entire system. So these are the businesses which we really like and want to continue holding from a longer term perspective. The last part is the promoters, which is very, very important. We think that the promoters are critical and should remain very, very focused on the business. The way we look at it is that the promoters should actually be having 70 or 80% of the business income coming from this business. So the expectation is that if the business does not do well or the stock price does not do well, the promoters are also indirectly negatively impacted by the same. So that's the last part of it. These are the 5 simple things that we are looking for across our companies, that we are looking for to shortlist companies and which we believe have been able to create wealth historically as such.
Right. Sure. So these are really quite insightful 5 filters that you have explained. For everybody to kind of remember. Can you maybe quote one example and then explain this equation once again of increase in volume multiplied by consistent price, and then multiplied by the other 3 factors that you had explained.
If you look at, for example, you look at Maruti from 2007-8 onwards till probably about a year ago, 2019, you will see that even throughout the depression that we had previously in 2008, there was not too much of a volume degrowth. It was a flat volume even in the worst year. In all other cases, the number of cars produced over the years has actually been rising as such. The second part is the pricing. In terms of pricing, if you look, we have moved slowly and steadily from a Maruti 800 to probably a Alto over a period, moved to something like a Nexa, where prices are much more, cars are relatively much more expensive, and then slowly moved to a Brezza kind of a model. So every car that they are producing is actually becoming more and more expensive. This is exactly in line with what Indian middle class is moving at. So as more and more people get into middle class and middle class get into upper middle class, Maruti is exactly migrating its product portfolio in terms of pricing from lower end cars to slowly moving towards the higher end cars at a very gradual pace. So probably a decade back, the average price was around 2.5, 3 lakhs. Today it has gone up to 5.5 lakhs. So that's the change that we have seen. The company has been a net cash company throughout. It has a treasury book even today of close to around 30 or 1,000 crores. Which is cash surplus. And what this does for Maruti is very clearly that the cost of production has always been low. It's a volume game for Maruti. If you look in terms of the last decade, you've had guys like Ford and GM which tried entering the market, who were foreign guys, had great amount of money, tried penetrating, but were not successful because of the selling strategy in terms of rural penetration that Maruti has been able to do. So these are some of the examples that we are looking for, wherein you would have made huge amount of money over the decades to go through, and where there is enough tailwind from the company perspective as such.
Sure. So I'll just like to give one disclaimer that, though we are doing quite interesting discussion and we are discussing some of the stocks, there is, these stocks are not at all, being kind of to be construed as any kind of an advice. These are just for an example that we are discussing these stocks. Now I'll come to the, third part of my question in this discussion. How important a role does an allocation per stock plays when we are, trying to build a portfolio with the perspective of attaining 10x in 10-year kind of return?
Yeah, so I think that a lot of us underplay the part of allocation. So very clearly what we think that if you look at any successful businessman, the primary income of this businessman typically comes from just one or two business. That's it. We've hardly found any businessmen who are ultra rich or who have grown substantially from multiple owning of businesses as such. So we want to follow the exactly same philosophy. We clearly think that if you invest in a business which is really very good and have a concentrated portfolio, from that perspective, you should be able to do much better. Another way to look at it is that we all know that HDFC Bank is one of the best banks. I think the biggest problem in terms of wealth creation that we have seen is that we typically end up having 2 or 3% weightage in a HDFC Bank. So despite the fact that it has really done very well, we've not really managed to create wealth. On the other hand, you will find certain investors which obviously had a huge stake from their own wealth perspective in a stock like Infosys or a Wipro, and who have been able to create that kind of a huge wealth. So I think we typically end up underplaying the allocation game. Another example or a way to look at it is that if you actually would have invested at the peak in 2007 in a stock like Asian Paints and a stock like Suzlon. So we all know that Suzlon has gone down the drain. So from probably 500 peak, it is like 10 rupees or 15 rupees today. But had you invested the portfolio equally in terms of Asian Paints and Suzlon, that portfolio would have actually outperformed your Nifty by a substantial 10% kind of CAGR over such a period. So if you really have a good concentration to a good stock, it really helps you create and outperform the benchmarks substantially.
Yeah. So I would support that, and I would just like to explain and add to what you're saying, with a very easy, simple way. I learned it many years ago that when you invest maybe, say 50 rupees each into stocks, right? The possibility of stock which is not a right stock going down is up to 50 rupees. So 50 can become zero. But the other 50 which is invested in maybe Asian Paints, it can multiply to any number, right? So it could become 250 or 550 or 850 or 1050. So the downside obviously is limited and upside could be unlimited. And that is possible if one's portfolio is not too much diversified. However, having said that, there is a saying that one should not put all eggs in one basket, and there are a lot of portfolio managers who have come and I have taken their interview. We have done similarly simple conversations with them. They are of the strong view that we are in a very volatile world, we are in a very complex world, right? So nobody could have researched, for example, this unprecedented event, right? And given so many uncertainties, so many complexities, it is unwise to put money maybe in very few concentrated companies. It's very good to have a diversified portfolio, because beyond a point you cannot know everything. So how do you defend that part?
Again, I think that we need to look at it from two perspectives. One, clearly, we think that investors who have at least a 3 to 5 year horizon are more appropriate to equity. So from that perspective, we do agree that there can be volatility within a shorter time frame. But from a longer time frame of 3 to 5 years, we should be able to generate a good amount of money, despite the intermediary volatility that we will see. And we typically tend to ignore the volatility and very clearly focus on the business. And if the business continues to be very strong and continues to deliver numbers, I think we have not moved away from it. That's point number one. The second aspect is in terms of how we look at it from the number of companies that you are looking at. So we typically have had 5 to 8 companies, and as a philosophy, what we have typically done in this is that we have chosen these companies from different sectors. So unlike a mutual fund, which typically has 2 or 3 different companies from the same sector, for example, in IT, these guys would typically have a TCS, a Infosys, and a Wipro in their portfolio. What we say is that let's have one IT company, one pharma company, one manufacturing company, one automobile company, rather than betting 2 or 3 percentage on each of the three IT companies. We would like to have a 10% allocation to the best IT company that we feel is more credible of. And between various sectors, if this is done to that extent, there is enough diversification and risk management that we have actually been able to build. So while constructing the portfolio at the entirety, we've been able to manage the risk, whether it's in terms of interest rate, foreign currency, any specific raw material, any specific commodity, whether it's in terms of oil or raw material in terms of steel, aluminum, or some of these things. We've been able to manage it over a period by making sure that we invest in various sectors while choosing these 5 to 8 companies as such.
Right. So
And just to add, sorry, if you look in terms of our historical track record, in terms of the typical way that a lot of fund managers measures the risk, whether it is through volatility or through beta, we've been either at par or below market in terms of measuring the risk. So our beta is much lower compared to that of the index. And if you look in terms of volatility, we are almost at par in terms of the market in general. So for the last 10 years, I think we have been successful to manage the risk aspect despite having a concentrated portfolio.
sure. So this is quite an information that despite concentrated portfolio and one getting benefits of concentration, the beta of the portfolio is relatively lower, or it is similar to other well diversified portfolios. Coming on to the next part, so because this information kind of mostly answers and makes it very objective, so there is no point to debate this any further. I will go to the next question. So the next part is we know that whatever you discussed is a very known, is kind of a very simple thing, right? It's not at all a rocket science. Anyone can, understand and do the way, this research you have framed. But the reality is that on one side we have so many stories of many stocks, like you gave an example of Maruti, Asian Paints, Bajaj Finance, right, which would have given maybe 10x, 15x, or maybe 100x kind of returns over a period of 10 years. But there is one reality of these stories. The other reality is that investors in general who try to invest on their own, by delving through stockbrokers, end up making poor returns. They end up losing money. They end up burning their hands, and ultimately they become, their experience is always very bad. What are the reasons? What is it that is wrong in that way of, in when one invests on one's own? What are your views in this regards?
Yeah, so I'll just share some of the typical mistakes that we have seen from retail investors as such. First and foremost, I think it is trading. So what we've clearly analyzed over a period is that we have not seen a single trader who has bought his own house in South Mumbai till now. While as if you look around, you will find a lot of investors who have been able to purchase their own house in South Mumbai. What it essentially indicates is that typically the traders have not been able to create wealth. It's the investor community which has been able to create wealth. Going back to your earlier stuff in terms of 10 times in 10 years, I think the time is a very, very critical part to all of this, and we need to spend enough time in the market rather than timing the market. The other way to look at it is again that if you look in terms of how much of the returns are typically contributed for Sensex or Nifty, in terms of percentage, there are hardly 5% of the days which majorly contribute to a lot of returns in Sensex or Nifty. And from that perspective, it is very difficult to choose these timings at a right time. If you have been invested throughout all of this period, it is really very easy to make that kind of money on a relative scale. So that's point number one, that you need to be an investor rather than a trader. The second aspect is to obviously have a good discipline. We've seen a lot of people who actually behave in an irrational manner. If you actually look at some of these strong companies, so for example, again, Asian Paints, in 2007 and the fall, the entire universe for Purnartha as an example had corrected by almost 40%. So it is not that during bad times some of these stocks don't correct. It is during these bad times all these stocks do correct almost in line with the market or marginally outperform the market. What is more important is not to throw in the towel at these times and stick around, make sure that the businesses are really good, and then stick around for these to recover. Again, as an example, what we have seen is that the universe itself recovered much faster in a year's time compared to what market took is typically 2.5 years time to recover in 2008 from the depression. So fundamentally strong companies have been able to recover much faster. What we have seen historically is that the moment you have a loss, a lot of guys typically throw in the towel. And on the other side, you have some of these other extremes who keep holding stocks like your Reliance Infra or Yes Bank or DHFL. Now that they have come off from 600 to 20, these guys don't want to just move on and close these trades. I think on both aspects, you need to be very clear as to when to change and make the tough call, when to stick around because the stock is fundamentally strong. I think that understanding can be done very easily by a professional, probably a bit tougher for a retail guys, but it's really very important from that perspective to understand when to do either of the two stuff in terms of decision making. That's what I've seen. The last part is obviously, I think, more important is the ability to hold on. So we've done an analysis saying how many of investors have been around for through AGM for Asian Paints or HDFC Bank. So what we have done is gone to the AGMs of some of these guys and asked them as to how many of you have been holding the stock for last 8, 10, 15 years, and we have hardly found people. So despite we all knowing that some of these are obviously good businesses, we don't actually stick around with them from in terms of time. Also, I want to just add the last part that a good business might not always remain good forever. So we've had situations wherein, for example, an ITC kind of a business, which has historically created wealth, but if you look from a last decade perspective, the stock has not done much. So you need to look in terms of the 5 principles that we have discussed, and the moment some of these stocks don't meet the principles, we've exited the stock. That's what I think we've been able to do diligently as fund managers, follow the discipline. So I think that's another important aspect that I think we have seen a lot of retail people miss.
Right. This is, I think, very insightful. Then I come to the last part of our discussion, which is valuations. And again, I would like to take example of one of your, your stocks in your portfolio, in your investable universe, which is Avenue Supermart. So, we have discussed a lot about this company, but, I would want you to kind of explain how do you defend, PE of more than 100, around 125 for a company, obviously which has a unique business model. So you can explain how this is a unique business model, and given that it is a brick and mortar kind of a business model, and COVID would have impacted it equally, and a lot of competition from especially a stronger player like Reliance Retail is expected to come. Given these realities, how does one comfortably invest into a stock like Avenue Supermart, and that to a concentrated bet right at these valuations?
Uh, so, as you rightly said, I think Avenue's business model is pretty unique. The first and foremost difference that we need to understand or realize is the fact that he actually owns a lot of stores. Compared to what you see typically in a Trend, Star Bazaar, or even Big Bazaar, which typically end up leasing the store. One of the primary disadvantages of leasing the store is one that you end up paying rental. So typically rent accounts for around 6% of the revenue. So to that extent, the expenses are higher. That's one. Secondly, what typically happens is that you need 1 or 2 years to set up the business successfully. Now, after these 1 or 2 years, typically your agreement in terms of lease are there, and you have to renegotiate with the owner. And in a successful business, typically the lessee will actually have to pay much higher rentals. So from that perspective, what we have observed is that rentals are absolutely not there in case of DMart, which is a very, very big positive. The ability to hold on to a good property is also very, very important. That also DMart has it because they own the store. So that's point number one. The second aspect is that in retail, what over a period we have realized is that the touch and the feel is very, very important. So example to go through it is that whenever you buy your wheat or rice, you have always seen mothers or wives actually touch, feel the stuff, and then decide whether it, or smell the stuff, and eventually decide whether we should go ahead buy some of this. Now, if you look in terms of history, DMart's stores are typically vacated in 15 days. That means the entire inventory gets exhausted or sold in the first 15 days. You compare that with a guy like your Big Bazaar, and it typically takes around 2.5, 3 months. So to that extent, the food that is there available on the shelf is much stale compared to a DMart store, which obviously is one of the big differences why we think that DMart is relatively successful. The third aspect is obviously the presence. So number of stores is still around 425 across India. So to that extent, it still remains an under-penetrated business within India. As the number of stores are expanding, the growth is going to continue. The company is going to continue having a strong growth. Also, the fourth is obviously the existing number of stores. So the 425 stores that it has are still growing at a rate of 10% year on year in terms of their internal sales. So if you look from that perspective, the growth is driven by multiple factors. One, existing stores growing. Second, additional number of stores that are being added. That's continuously happening. Third, the number of bill cuts that are actually rising. So every year, the number of bills that are cut by various customers is actually increasing, and so is the amount per bill also increasing. So all these things combined is giving DMart typically 25 to 30% sales growth. On the bottom line aspect, as the business remains or as there are scale opportunities, and as the scale continues to grow, the margins have been expanding. About when the company got listed, the margins were around, I think, 4.5%. Today they are closer towards 8% in terms of EBITDA. So as the scales are improving, the systems are already in place, and hence there is operating leverage which is kicking in that in the entire business. So we, from that perspective, we really expect the bottom line to continue grow at 25-30% plus kind of a growth rate. And if you look from the PE perspective, till the time this 30% kind of a growth rate, we believe that the PE and the stock price looks relatively sustainable, even at 100 kind of a multiple for us.
Right. So we lost you just in the last sentence when you said the P goes to what level it is sustainable. Can you please repeat that?
So the PE of 125, although it is there right now, if you really look at 4 or 5 years, you would still make a good amount of money if the PE declines to probably around 50 or 60, which is like that of a HUL. Even then, just because of the growth, you will actually end up making a decent amount of money, closer towards 20-25%. And that's the logic for saying that we are fine with the stock.
Sure. And in what context are you saying that P would decline, that earnings would increase?
No, so assuming that the P might decline to 50 kind of stuff from 125, if it doesn't decline, you obviously end up making 40-45% return more in terms of PAT. But even if the P declines to a reasonable number like 50, which is like Asian Paints or a HUL kind of stuff, even then you are making reasonable amount of money at 20-25%, since the profits grow at 35% on the bottom line terms.
Sure.
For the next 7 years.
Sure. So you're saying that assuming that profit earnings are growing at 40%, right? The stock is kind of expected to double every 2 years or maybe 2.5 years. In that context, even if the stock price falls to adjust to a lower P number, right? Despite that, the net return for an investor could be at maybe 15 to 25%, even at a lower P.
Absolutely.
Okay, sure, got it. So now this part of conversation is more or less over. Now we will come to questions and answers, right? So we would like to first ask you a question with regards to what is your view and what is Purnartha's view at present on various sectors. So what sectors are you kind of avoiding, and what sectors are you liking?
So historically, if you look, we've always been avoiding your telecom companies, your infrastructure, power, companies, capital goods, equipment manufacturers. Typically, these companies have a lot of debt in their books, and the moment there is an error in terms of either execution or delay because delay in terms of order or receipt of money, we've seen that some of these guys get into trouble. So historically, we have avoided some of these sectors. What we have always liked is IT, pharma, consumer discretionary businesses, insurance, non-life insurance businesses. We have also started to look at some of the chemical companies. So as of now, so these are typically the sectors which we prefer, and rest we try and avoid as such.
Right. And what are your views with regards to financial services apart from the names that you have taken, like life insurance companies?
So in terms of financials, we've did a lot of study of late, and what we have realized is that for India's GDP growth to be at 6%, we will need financials in terms of credit growth to be around at least 8-9%, which was a historical number before the COVID collapse. We've done a lot of study for some of the emerging market as well as developed market countries, like whether it's US, Europe, or emerging market countries like Thailand, Brazil kind of countries. And across all these nations, what we have realized is that if the GDP has to grow at a certain rate, the credit growth has to be there. Otherwise, it's really very difficult to bet on a GDP growth of growth. So from that perspective, if we are really projecting a growth going back India to 6%, even in 22, I think the credit growth should be back at around 9%. And from that perspective, we really continue to like consumer-focused BFSI or banking companies, typically more focused on consumer stuff rather than corporate stuff. So the other way that we have understood banking business is that you need to look at the duration of the loan book. At the shorter the duration of the loan book, the better it is, because the predictability of the banks while lending is relatively better off compared to a corporate loan book, which typically might last for 5 or 8 or 10 years, where the predictability inherently goes down as such, and
Right.
hence the default risk increases as such.
Right. So what is your view, or maybe your or Purnartha's view on Reliance Industries? Does Reliance Industries now come into the investable universe of Purnartha's investment philosophy after we get to know that it is becoming debt free as a company?
Yes. So after becoming a debt-free company, it does fit from that aspect. We've not yet seen the growth aspect being fulfilled, because a lot of revenue still continue to come from your erstwhile chemical businesses. Very recently, we first started to see your geo contribution, but otherwise the top line necessarily is not growing at the same pace. So as of now, it is we are watching it, but we are still not convinced that it absolutely fits the philosophy in all terms. So I mean, just to go back, I think that we clearly want everything as a and not or. So from that perspective, just becoming the net cash does not tick all the boxes. The other boxes in terms of volume growth or OCF growth are still not being ticked. So as of now, we are away from the stock.
Right. So when can you just give us some perspective on how does numbers look like when you maybe work with these filters? So how does it work? So there are around 10,000 listed companies, right? On 10,000 listed companies, how does number look like, and how do you ultimately come to those 5-6 stocks? Are there not many companies which fulfill these filters, or you specifically just pick these 5 companies?
So if you look at the universe, out of that, when you try and filter net cash companies, which is one of our biggest filter, there are only around 450 net cash companies. So that works like our biggest filtering criteria in terms of reducing the entire applicable universe. Post that, if you look in terms of having 15 to 20% sales growth and 20% OCF growth, we come down to around 150 odd companies. From there, when we look at the promoters, where we are convinced that the promoters are clean, there's no issue historically, anything wrong that they have done, we come down to a universe as of now of 30 companies. So that's our hardcore universe as of now of 30 companies. From these 30 companies, we are trying to select 5 to 8 companies. As I said, we want to select just one company from every sector. So there are times wherein multiple companies get shortlisted from one single sector. The idea is to select one of them, which is probably best positioned to gain, whether it's through valuation and in terms of sustainability of the growth. As such, that's how we arrive at the 5 to 8 stocks. As such.
Sure. So I think, it has been pleasure talking to you. I would like to end here and like to conclude by, saying that it is obviously, not easy to generate 10x in 10 years as a premise. It requires 10 years as a time horizon. It requires a very disciplined approach. And it also required, a very high conviction in building a portfolio. One may not be able to build such high conviction portfolio for 10 years on one's own, and that is the reason one needs to rely on credible research licensed SEBI licensed companies, and that is where maybe Purnartha is one of such an institution. So thank you so much, Devender. It has been really insightful interacting with you and knowing so much traits to build a portfolio for 10x in 10 years. Thank you.
Thanks a lot, Thomas, and thank you everyone.